So my background is as a credit analyst. It's a very similar role to an equity analyst. We're both looking at companies to invest in. But whereas an equity analyst will look at the equity story, a credit analyst is really focused on the credit risks, so the risks of lending to a company, because a bond is simply a loan to a company or to a government. So I began in the industry about 2 decades ago as a credit analyst. My focus at the time was on the high yield bond market, formerly known as junk bond market. That is where credit risks are naturally higher because of the types of companies that you're investing in. And today as a fund manager, that credit analyst experience is still central to my role in managing 3 income-focused bond funds, which includes Invesco Bond Income Plus, where I am the lead manager and have been managing the fund and its predecessor trust for almost a decade now. So the investment objective of Invesco Bond Income Plus, or BIPS as we also call it, which is the stock market ticker, is that the trust is focused on generating a high level of income with capital growth by investing predominantly in the bond market. And what that means in practice is investing in a diversified portfolio of high-yielding bonds to achieve a dividend for our shareholders that is, most importantly, sustainable. The current dividend is 11.5 pence per share per annum, and that remains the dividend target for BIPS going forward. In terms of income, because BIPS is focused on paying a high level of income and achieving the 11.5 pence dividend target, the focus is on naturally high yielding bonds, predominantly bonds in the high yield part of the bond market. And this is where our focus on credit analysis becomes very important. So we want to invest in bonds from companies that will pay us the interest each year and whose credit risk we really understand. So to give an example of a recent purchase, we bought a bond from BT. They issued that bond in June with a coupon of 8.375% or 8.38%. Now, you can have a view on the share price of BT, but with their bond, what we have is an agreement with the company that they will pay us the 8.375% coupon. That's the interest income every year for the next 5 years. So we're always working hard to find bonds like that we can put into the portfolio to help it generate that level of income that we're after. And it was actually a very tough period of time to find bonds paying a high level of income like that over the past couple of years, a couple of years ago, without taking a lot of credit risk. But thankfully, today, for an incoming investor, it is a very different environment because of the higher interest rate environment that we are in. So I would describe the investment process as being bottom up. So it's a commonly used term, but it does do a good job of explaining how we start by looking at companies that we invest in. We really need to understand their cash flows. So the strength of the balance sheet, the industry they're in, and the outlook for them. And that also means meeting management teams is very important to us. So with that bottom-up view, we can take that information, form a view on the credit risks of the company, and then with that, we can decide whether their bonds will pay us enough or are paying us enough yield for taking that level of risk, and we can build up portfolio of bonds. Once in the portfolio, we have a team of analysts who are constantly updating their views on these companies as they report earnings and as the story evolves. And then for BIPS, because we have that income target in mind, that 11.5 pence per share, the other important job for me as a fund manager is to put together a portfolio of bonds that can achieve that target and to do so as prudently as possible. Finally, I would also point to the diversification of companies within the BIPS portfolio. So we invest in bonds from over 150 different companies. And that's because a bond is a different risk reward profile to an equity. So spreading that credit risk over a large number of companies is, I think, very important. So as of today, the trust is currently trading at a small premium to its NAV. So that means its shares are trading at a slightly higher price than the net asset value of the portfolio. And I believe that we are the only trust in our sector doing so as of today. I like to think that it's because the market appreciates the consistency of dividend and also the positive environment that we're in right now for income investors. Should that premium change to a discount, then the board of BIPS will certainly consider the steps they can take to mitigate that. And we have had discussions in the past about that. Sometimes, though, a discount can be due to a widespread issue rather than being specific to a trust. And that was something that we saw happen during the start of COVID, for example. So it does depend on the circumstances. But I'm happy to say today we are trading at a small premium. So the annual management fee on BIPS is 0.65%. That is one of the lowest within our AIC sector. The management fee was reduced in May 2021 when BIPS was formed through the combination of the two predecessor investment trusts that we also managed. The combination of those two trusts to form the BIPS vehicle gave the board and it gave Invesco the opportunity to reduce the annual management fee from what was 0.75% to 0.65%. And then, of course, also the larger combined size means that BIPS can now also benefit from a reduced overall level of ongoing charges. And that was another reason behind combining the two trusts. And hopefully it's something that shareholders have been happy with the outcome.